Hey guys, Freaky Finance here. Today we're going to do a different kind of video. This is just what I thought about doing a long time ago. Like, the mindset is what would 18-year-old Freaky wish he'd known back in time? And really, instead of like company specific, which we do for pretty much the whole channel, it's more just overall thoughts on investing, how I help myself nowadays, and what I wish I would have known back then. And I'm sure like a 36-year-old Freaky thinks things about differently than 18-year-old Freaky will, and I know 54-year-old Freaky is going to be like, what the heck was 36-year-old Freaky thinking? So this is going to be one of these fun ones where I get to go back in time, like 5 years from now, and look back on it and be like, what's still wrong? What needs to be improved? These are just basically, I just picked 12 slides to try to like visually get things and bring them together really quickly. And at some point I might go into detail on them and kind of build on this, but this is just kind of ground zero, make some notes about basics of investing and principles, and just try to help people as much as you can. So I might ramble a bit because I haven't rehearsed this before, but this is just one of the main things, especially early on. You're always trying to wait for a pullback. Whether like when you're 18, I mean, I got kind of lucky because I was around 2008, 2009, but you're always trying to wait for a pullback in the next one. I remember waiting the whole decade of 2011 to 2012, 2013, 2014, 2015, waiting for pullbacks, right? So you're sitting in cash or ISAs and stuff like that. And you just kept seeing the market go up 10 or 20%. And this is what I wanted to see on the side. And this actually shows you a few things. It's just how, and a lot of these things are taken from other people. There's great visuals. So props to them. It's not like I get monetized on this platform. So it's not a big deal. I just like good visuals, so shout out to this guy. But you can see the positive skew here, right? Over time, the stock markets generally go up in most years. This is America. So this one actually goes up quite a bit more than the others have in the opportunity set. But you can see in terms of percent terms, you can see quite a lot in the 10 to 20%, actually the most. So quite a few years is actually a pretty good median to 10 to 20%. But you can see the positive skew, right? Only the first 5 columns are losses in a year. And that's not bad over, that's 95 years, right? So 95 years, you have 3 bad ones between 30 to 40%, right? And then you have another 3 in the 20 to 30. So really you have 6 pretty bad years out of 95, right? And then if you add the next one, which is another 6 from 10 to 20, then you have 12 bad years out of 95. Though that other 6 would have not been as bad. You would have really only 10 to 20% down, right? Which might have only been a year that you just gave up in terms of the average return that we've seen, especially lately. So that kind of helps skew things, right? So there are going to be years where you lose money, but in the long run, you can see how it skews favorably to the right, to the positive, like a lot more positive years. Now, what I also like about this chart is generally there's some type of mean reversion. So usually after a very bad year, not always, but sometimes, right? You can see here 2001, 2002, back-to-back bad years, right? Even 2000, so 3 bad years in a row. But what we have seen is generally after those bad years, there's usually pretty good years, right? So an example here would be, let's say 2008, right? To 2009 right here, right? So 20 to 30%. So pretty good year after a bad year, right? But it also set up for 2010, which is another good year, right? And then 2011 was still positive, and that was with a double depression in Europe, which we were still able to pick up good REITs and banks on the U.S. side because that was took a while to get out of that on the great financial side for the financials themselves in America. So we were able to pick up Bank of America at $5 there. I remember trading it, and you can just see how this mean reversion works, especially so after you have a bad year, you have to get excited, and that's what I would tell 18-year-old Brian as a 36-year-old is get excited after the down years because they don't happen very often. And if they do, usually they mean revert. I mean, the exception there is the .com bubble burst, right? Took 3 years to get out of it. But normally, right, you have 2018 and boom, 2019. So bad 2018, good 2019, right? So it's good to keep that in mind, right? Like bad 1937, great 1938, right? So years where the stock markets go down, generally opportunities. And longer term, obviously the opportunities there. It's positively skewed for a reason. Now the media will always focus, and a lot of the doom clickers will always focus on Great Depression and great financial crises as common pullbacks, right? But you can see them here. Great Depression, horrible, right? 1931, horrible. 1929 was horrible. 1932 was horrible, right? Very bad. But they focus on it, they anchor on that as if it's normal. And we've seen improvements in financial literacy from the big central banks not making the same type of policy errors, being almost probably too supportive in some cases. Like COVID turned out to be probably overstimulative, right? That's partially why inflation happened. Right? And they'll never get it perfect, but they're getting better. And I think that's why we've seen less super bad in terms of frequency. We've seen them respond to slowdowns in the economy better over time, or at least that's what I'd argue is happening. Canada follows a similar skew. I'm just going to blow this up. But it's not as, it still skews positive. You can see 0 to 10, to 30 to 40, but there's no plus 50% years. There's less in the 10 to 20. There's actually more in the 0 to 10. So Canada's returns have been more in the 0 to 10, both in terms of median and mean, whereas you can see the Americans in the 10 to 20. And the 20 to 30 is also very large. So to be fair, 20 to 30 in Canada can be very large sometimes. So, but you can see again positive skew, and you can see there's only 3 really horrible years, right? Over 20% losses, right, in the last 72 years, right? So that's not bad, right? 3 horrible years out of 72, and then if you add the next one, the minus 10 to minus 20, 9 out of 72, right? And the media will always focus on these, even though they only happen once every 10 years, right? And sometimes they're not even that bad. So, especially after a couple years, if you've just been up 10 to 20, right, you're not even going to notice. So again, the same wisdom there, just take advantage of weak years, especially because oftentimes they mean revert in the following years. And if it's not the immediate year after that, it's usually right after that one. This is another good chart. This is just helps. I can't remember where I pulled this from, but it's just a great one to show time in the market beats timing in the market. So starting early, and that was one thing I got right, was starting early. I think school helped with that. It's just learning as much as you can, as fast as you can, and start investing. Be okay with making mistakes, but start early, because it starts the snowball that we're going to talk about a bit in this video. And I think it's huge in the long run, right? You can just see the dollar value here, over 500,000 by the time they're 65, just 200 a month at age 25, right? But he only contributed 96,000 of that. Whereas Jill, who starts later, 10 years later, right? She's only going to be at 250, so half that, right? Just by waiting 10 years. Same amount she's putting in each month, just she started 10 years later. So she's 50% poorer, right? Now she put in 24,000 less, but you can see the multiplier over time, right? This gap between the two over time is widening, and you can see the curve actually steepens, and that's momentum. And then you can kind of see it like the base one when they start very late at 45. You only have 100,000, right? So you're 80% poorer, right? By starting 2 decades later, and that's the power of compounding over time, and it really does pay off in the long run if you start early. And time in the market beats timing in the market is a great little thing to remember that. And why is that? It's because of the compounding effect. It's because of the snowball. If you don't read the book, one of them is titled Snowball. It's a great book, and that really helped me start getting this picture down. So start early, and this is by what I think is most important. So I spend all my time on stock selection, even though it's not even on this list. It'd be asset allocation and stock selection underneath it. It's just that's just how I treat things. So starting early, starting yesterday is the best day. And no matter how small the investments are, they add up over time. So even if you feel like you're not doing anything today, it's going to start snowballing tomorrow. And I think having that faith earlier on, right, especially when you have so many things you want to buy and you're younger, so you have a lot of things that you need to pay for, right? Might not have kids yet, but you have school, you have, I don't know, you need a car, all of a sudden you're getting married. There's a lot of big ticket things that come up. And so I understand that there's so many things you want to buy, but especially avoid the flashy things. You're not going to need them. It's just the first thing is time, just starting early, and small investments add up over time. Starting small, just starting early. Savings rate. So this one's harder, and I'll probably do another video on ways to save money, maybe the things that I've learned over time. A higher savings rate especially helps you out early on because you get more time for the snowball. So, well, I said starting small is great. If you can save even more money and invest it earlier on in your life, it really does start snowballing. And you're already starting to, like, I'm only I probably started at 18, right? So I'm 36. So I've only had 18 years, but I'm starting to see like some years you make more than your salary, right? And so it's already starting. So I would say it doesn't take long, like maybe a decade, and you start really seeing the benefits of the things. All of a sudden, like the most you could save is what you're making sometimes in a day in a swing. And that's because of momentum. It really does add up over time. The compounding effect is huge, and the more you can save earlier on, it just sets you apart so hard. Asset allocation. So we haven't talked about bonds too much. I think we did once. We did a video on preferred shares once. A safer asset mix, so more bonds and equity, will yield a lower rate of return. Usually, that's just the risk reward principle. So riskier asset classes tend to generate more return. And so this can be good or bad depending on the person. Some people, everyone's different, so the asset allocation is very hard. And so I have one of the things I do like about the modern thought process on risk management is that they do try to tailor it, even if they're cookie cutter tailors. They do try to get, like, the people that are very risk adverse, have very low risk tolerance and ability to take risk. They do try to guide them more to bonds, which is probably prudent because you don't want to have that emotional response when things go bad, right? So when the stock market goes down, you don't panic and sell, right? Because that's the exact time that I buy, right? That I've trained myself to buy, and I know it works. So, but if you have an emotional response to that and you sell, that's the worst thing. So this is a way where I think modern finance is actually good, and it helps people who are more likely to have a panic, or maybe they don't understand things. They just see the red, right? They see, oh my God, I had 200,000, now it's 160,000, or whatever they had. They had 50,000, now it's 30,000, right? That's a huge 40% drop. They're going to panic. And so you want to avoid that for those people. So you want to put them in safer things that don't move around as much, like bonds. But at the same time, that means that you're sacrificing the snowball effect, especially early on in your life. And so I would say here, for younger people who do have ability and tolerance to take risk, right? You have a lot of human capital. So if things go bad in a year, you don't really care. It's not a huge deal. It's probably not a big sum of money yet earlier on in your life anyway. It's just, I've always been equity very dominant. Maybe an exception was 2018, 2019, which I was early for a COVID thing. I didn't even know was going to happen, right? I was just thought things were too expensive, which I could articulate that now too, especially for the States, for large caps, not small caps or anything else. But anyway, I still own them because I've learned that you can't really time it. You can just try to risk manage around it. But anyway, younger people, larger equity, it's just something I believe in. Though again, that's very, you never know who the person is, right? So you don't want that emotional response if someone has that not ability to tolerate that kind of risk and that kind of movement, right? You really want to avoid that emotional response. And that's the main thing. And then the last one is the tax overlay. And this one I've kind of added over the years. So this is Canadian focused, TFSA and RSPs, but I've read a few tax codes, just the Western ones, and they're all kind of similar. They all very, very much favor income earned from investing over income earned from working. So your tax rate, your marginal tax rate is almost always better if you make more money from, say, capital gains or dividends, especially Canadian eligible dividends in Canada. So those two things are great. Interest income is not as great, but if you can help overlay your asset allocation with your TFSA and RSPs account, you really get that snowball going over time. And I'm going to have another good slide on this that kind of breaks this down. But how I view it in terms of the snowball coefficient is the tax is like the friction coefficient. So like as you're going down that hill, the less tax you pay, the more the snowball can grow quicker, especially earlier on. And it can be really huge. And that's what a lot of people miss with RSPs. It's not just tax deferral. It depends what you do with the money that you didn't have to pay in taxes, especially if you invest it. I think I have made a good slide on that one. But this is just one because it's topical, because Trump's about to come into power. Government policy can matter. There's a time where I thought it didn't, but it can. I've seen it matter, but it can be very sector specific, and usually the markets almost always look through it, right? So here's just one right here. You can kind of see just how, again, positive skewed. Long enough time period, you're probably going to have positive stock returns. Democratic sweep, Democrat president split Congress, right? And you can see over time very well, and this is the Republican sweep that we just had. This is the average in that time period over the last 71 years, right? You can see 12.9%. So third best setup, technically, in terms of a political landscape. So I just thought that was interesting because a lot of people anchor on who the figurehead is, what the government is. I'm like, And you got to remember, these are businesses, and they operate under all types of government policies. Now, some can be very bad. Like sometimes you have very bad healthcare policies. You can have defense spending policies that really impact defense companies, right? You can have a lot of policies that affect things in the short term, but longer run, the market rides through it. And now, so you need to be aware of them and how maybe they affect some of your businesses if you have like a concentrated portfolio and certain things that are especially sensitive to these policies. But longer run, zoom out. It's not as important as what you probably think it is, and that's something I would tell younger freaky. And just remember, the stock market tends to go up over the long run, regardless of who is in charge. History of bull markets and bear markets. I think this just helps visualize kind of just how much more powerful and longer bull markets are, and it helps visualize like don't wait for pullbacks forever, right? If you're just going to wait, like, so you can be waiting 10 years here, 5 years here, 12 years here, and you've noticed that the bull markets have kind of gotten longer, and a part of that, I think, is because the governments have figured out how to support the economy better through monetary policy. And that's what I think over time. That's why they have gotten longer over time. But that's just my opinion. There's a lot of people that probably won't agree with me, but that's just what this chart shows me, and it's what I've seen. And again, the same idea is take advantage of these bull bears. Now I have more tools now because I have more money to do it, but earlier on, waiting was not the right strategy. It was just getting in and then taking advantage of this, knowing that this is an opportunity. This is when things are on sale, and then you buy the hell out of it for the next 7-10 years, whatever you want, right? And then you can peel back risk if you want to. That's kind of how I've learned over time, is this is buy time. This is when you can get really excited about great companies at finally good prices that you've probably waited a decade for to get. So this is just, I thought this is just a good visual to show the power. And again, it shows the positive skew. This is more of an asset allocation slide. And again, it's trying to show the power of equities in the long run. So this is just growth of $100 over 70 years, or 53 years rather. And you can just see the stock market just outperform, right? American stock market versus corporate bonds. These ones are represented by BAA, so kind of average, aggregate. They don't get the duration here, but, and then gold, you can see. So in terms of which ones outpace inflation, it kind of depends, but you can see that cash and treasury bills, real estate can be, but it's very specific how much you own and where you own it. A lot of people swear by real estate, but again, a lot of them only seen real estate markets go up, especially in America, right? They could have other countries that haven't seen that. But anyway, and that also depends on population, supply, demand ability, right? Are they building more houses? Are they inviting more and more people in? There's a lot of things that go into housing. So that one's kind of an outlier here from what most people would think. But over time, the main thing on this chart is the stock market and how much better it performs relative to other things, especially if you have a long-term time horizon. So things, when I buy bonds, usually it's when I'm getting scared and I'm not sure where I want to put my money. I'll put it into corporate bonds. And it won't be high yield because I have enough risk in my equity. It'll always probably be government issued sovereign bonds, and I'll pick the duration I want at the time, depending on what's happening, and what the curve looks like. But this is just, I just think if I had something to show 18-year-old freaky, it would be this chart right here. It's it just shows the power over time, right? And they'll like when you go to a bank, they'll try to throw like a little 70-30, and I'm like, well, why would I ever get recommended that now when I look back at myself, right? Maybe I didn't have ability to take risk or willingness to take risk, but now I understand things a lot better, and part of that's probably just getting older. And that's just kind of how I treat things, right? So longer run, equities went out, and one of the great things about equities is their ability to push inflation. It's one of the proven ones. So when inflation shoots up, just imagine their cost inputs of the company increase, and what do they have to do? They also have to push costs, and they all do it. And some companies will be way better at it. Some companies actually won't be able to do it. So it can be both industry and company specific. And some companies will go bankrupt because they can't do it. But in the long run, most companies will be able to push especially the largest ones, right? This one's S&P 500. They're able to push price. They got the scale, they got the brand. Whatever they need to push price, they can do it. Right, big railroads, big whatever they need, they can push it, right? And railroads is a great example. It was just one I was looking at again yesterday for CNR. But they just take price, and the largest companies in the world are the best equipped to push prices, what I'd argue and articulate. Though it does depend on the industry. And this is just another, I like this chart, just a quilt, and it kind of shows what things are in and out of favor over time. This is more of a style asset allocation thing. So lately we've seen large caps just destroy, right? Really, 2019, the whole way up, right? And we've seen that the best companies are getting better. They're getting bigger, they're getting smarter, they're getting more adaptive, especially the tech guys. They're getting the top talent, top smartest people in the world. And I think it's starting to show up over time. America also has great venture capital markets, so they're also able to create the best things that scale very well. And they give guidance to these founders that I don't think exists at a rate of return, like a rate of capital, that's actually a lot cheaper than you get anywhere else in the world. So I think that's partially what's happening here over time. And it's showing up like a sore thumb over the past decade, right? Large caps. But you can see certain times like REITs here top 3. But again, part of that is because they were so bad during 2008 and 2009. Because REITs got really hammered during the great financial crisis. But you can see REITs, another great one that I like owning. Small caps every now and then shoot up to top performer, right? So and small caps right now are dirt cheap, right? They didn't actually, like, it looks like they had a great year, but I mean, relative to what large caps have put up lately, and relative to the current valuations, the small caps look really cheap actually, where the large caps look really expensive, and it's kind of like, what's happening? And I think part of it is they flex their ability to take price. They flex their balance sheets. They flex their ability to take on, like, as soon as AI became a big thing, a lot of them jumped quick. There was no hesitation. There's no, what should we do? It was, we're doing this now, and they all did it. And that is special and different than other things I've seen before. So I'm kind of rambling a bit here. That's just kind of how I think about things. Certain things are going to go in and out of value, right? Bonds do perform now and then, right? They do, like, every now and then. You have a bad year. 2016 high yield bonds went 17%, right? Emerging markets have been out of favor for the last really 5 years. But you can see that every now and then even emerging markets will be top. So things change over time. And then you have bad years where cash is the best performer. And those are usually the best years. So you can see cash, best performer, following year, large cap, small cap, right? So basically it tells you whenever cash is the top performer in a year, you should buy large caps and small caps. And if you want, you can buy REITs, because I love REITs in terms of a risk profile that helps me manage my tech exposure, right? That's because it's property and it's tied to interest rates. I mean, and REITs can be anything, right? It can be office, it could be residential. We've done a few anyway on the channel, and I love REITs. It's just steady, nice dividend, very efficient tax structure inside of RRSP. But this just helps visualize things going in and out of flavor over time. This is just a great, what I would like if I wanted to show myself early on in life. It'd be this thing on the side here. I took this from a BlackRock slide. You can just see cash, lower risk, lower potential reward, stocks, higher risk. We talked about that enough. But here's the great thing here. You can kind of see which one outperforms inflation by the most over time. And you can see Canadian bonds putting up 3.3% on average, inflation 2.1. So you're still making money over inflation over time. Cash and savings does not. And then you have the outlier here, global stocks, 7.4. This isn't even US stocks or tech stocks, just global stocks in general. And global stocks haven't been amazing like the US stocks have over the last 5 or 10 years, right? They're still 7.4% over time, way outpacing inflation over the same time horizon. So this is just important to me, especially for building that snowball of wealth and compensating and getting that momentum going. It's just equities again just outshine against inflation, and that's something I would wish my 18-year-old self would have known more of. And I probably would have had a tracker on which companies would push inflation easier going into stimulus. Well, to be fair, we didn't know it would be so inflationary, but we had an idea. And I remember on the channel, I remember certain things. I'm like, this is going to be interesting, because we had half the economy still shut down, the service economy shut down, and we had people still making the same amount of money because the government was giving them money. So anyway, it was just interesting time. And this again is just variance. So a lot of risk and financial models, they're basically all value at risk or VAR. And really they're just they all assume normal distribution of a bell curve, and they all assume specific things. And what I like this one because it kind of shows me the available outcomes. So basically it says emerging markets riskiest, international developed stocks are next riskiest. I didn't realize that the US small cap stocks are actually less risky than international developed stocks, but give a higher, less risk in terms of volatility, which is what you'd measure it, standard deviation. But you can see the average return is actually higher, which is kind of interesting. And REITs, again, slightly less on the max return, still very low on the min return. Like when things get bad, it can get very bad still in REITs. But you can see the average 8.5, and the probable events is just shrinking, right? And this probable events is like the risk profile. So the smaller, like a T-bill, the risk profile is very low. International bonds, risk profile very low, but you can still see bad years. All US bonds, again, very low. And then high yield, which we haven't talked about much on the channel, just because I just have so much equity exposure anyway that I don't really need any credit risk into the profile on the bond side, especially because they're very illiquid if you want to own individual high yield bonds. I'd have to know an ETF, and then I probably need to know the top 10 holdings fairly well to be comfortable with any size of a weight of my portfolio. But I just view this as a good place to learn over time of kind of like what's the expected kind of returns in terms of averages, and then also what's the min max has been in the range that they've been under. So it kind of helps show the volatility. This is just the current valuation as of today for America. Again, you're getting expensive on the large caps, but again, you're not too expensive on the smalls, right? So, which could be interesting. Though we have seen large caps were able to buy back more shares, and they were able to take more revenue per share because they pushed inflation a lot better over the last 2 years. And some of the megas have really accelerated. Like there is true acceleration at Microsoft, right? Like we saw 10 billion now linked to Copilot and AI of their 60 billion, I think, in the last quarter. So material growth in some companies, right? Like Nvidia is off poster child for that. And anyway, in Canada, this is just what I pulled for XIC, which is like the top 60 Canadian companies at 19.3, which has been about kind of like the average price, I'd say, over the last bit. So it's not cheap. It's not expensive. I'd say it's slightly on the expensive side, but you can say that about a lot of companies right now, which doesn't make me excited about owning all the things that I own, but some things I'm very excited about owning in the longer run. So I just hope that I get a pullback in 25. But if we don't, we're already invested and kind of showing all my positions lately. TFSA and RSP's accounts. So this is just the tax overlay. Now I think of these, a lot of people, where they view them, they think of them as their investments in themselves. And I find when I start bringing them up to people, a lot of, like, they literally think these are just investments. Like I have my TFSA, yeah, and it makes this year. They don't know what it's in, they just know they have a TFSA account. And so I would like to tell 18-year-old freaky that these TFSA and RRPs accounts are really just houses, or just deciding where to locate your investments, is how I word it, kind of like a vehicle or location. And these are just specific bank accounts just to hold assets in a tax efficient way. And then I put here the CRA track sent through your SIN number so that you can have multiple ones. They just have to have the same. You can't over contribute, right, or they'll penalize you. So that's how they track it. And this is just something I made ChatGPT do. It's just, what's a TFSA account? It's like, and then try to explain it to someone just starting out. Think of a TFSA as a piggy bank that government says you can use to grow your wallet without paying taxes on it. And what's it for? Saving or investing in anything you want. Buying a car, right? So it's very flexible. You put money into it. There's a yearly limit. This year for 25 is 7K. So 6.5 last year, 7K. This year, any money you make inside the account is tax-free, right? With no strings attached. The RSP, ChatGPT describes it as a special account for your future self, your retirement piggy bank. What's it for? Saving when you're older, you don't need to work anymore, right? You get old, eventually you can't work anymore. You put money into it, the government gives you a tax break, and you get money back in tax pie. The money grows over the years in your RSP. You only pay taxes when you take it out later. So most people view like, oh, it's kind of rigged, right? Because you're just putting in now, you're saving money now, but you got to pay it later, right? And there's a couple of things here, and it's the one that's lost the most, because a lot of people understand the tax bracket. So maybe my tax bracket's high right now, it'll be lower when it's higher, and they understand that, so they're going to tax less, right? But they don't understand the time value of money, of delaying the tax over so long and allowing it to snowball. So this this thing right here, I just made a little visual, but it kind of just shows this is the money you made, you pay the taxes to the government, right? Versus the money you make, you pay taxes to the government, but you also RSP contribute. So it splits the amount that you're paying to the government. And so now your RSP is contributed and investing, but you get a tax return from the government, right? So I just made myself smaller. So here you can see you get a bigger tax return, which then can help fund your TFSA and invest it. So that's something when I was younger and I had the inability to maximize both my RSPs and my TFSAs, this is something I used, and I wish I would have done it earlier. So this is another thing for a younger freaky. It's just using what's available to you in the tax code to take advantage and get your snowball bigger, quicker, earlier. Lower that tax coefficient on your snowball as it goes down the hill and gets momentum, especially early on in life, because it starts snowballing. And so again, the process is just putting more money into RSPs. And because you get more money in RSPs, one, you're investing it in your RSP, so it's also starting to earn money over time, which is what most people do. But the tax return itself, assuming you don't need it for anything, you can put that in your TFSA, especially if you couldn't, if you couldn't maximize both. It's a way to help you maximize the TFSA as well. So not only do you have one thing growing, you have two things growing, and it's something that you would have never had otherwise. So that $5,000 you save in taxes in a year can really snowball over 30 years, right? So it's not just a tax deferral. Like, it is a tax deferral, but a lot of people just think of it as a bracket game, where really the time value of money of the snowball earlier on in your life can be very huge. And that's something I wish younger freaky would have realized. And this is probably the last one. This one I've avoided, luckily, but I've seen a lot of people, especially in that younger age group, right? The 18 to 25, you really start thinking like you need these flashy things. And this is partially my opinion, partially I just saw this on somebody's Twitter, I think, and took it off. I thought it was a great example of investing in the stock market versus buying a shiny thing, and the value over time, right, of a depreciable asset. Now, there are some rich cars, some really nice cars that actually hold value and sometimes appreciate if they're rare and scarce. Again, everything's a market. There's a demand and supply, and the supply of a very nice car, unique car, is very low. Perhaps the price goes up over time because the demand for that car, because it's rarely made, increases, right? So we have seen certain cars appreciate in value, but often, and for the average person, it's not going to. It's going to depreciate as soon as you take it off the lot. And this one just assumes 50% depreciation over a year. This one assumes 10% returns if you invested it instead of spent it. And you can see over time, this is just 10 years, only 10% returns, so nothing's crazy, right? Like, we've done better on the channel. But this is huge difference in that, right? You're 600,000 better off in 10 years, right? Just by deciding to not buy a flashy car. And so, and also the psychological thing here, and I could say this is just my opinion, many people who buy luxury items, status items, tend to rely on these items as cruxes in social situations. So it's not always true. Some people feel like they need it because they need to fit in, which is also just as dangerous. But strength comes from within. No one really cares what car you drive, right? They could pretend to. You probably care more than what they will. And they might actually be off-put if they see that you need them to, like, need you to see you in it, or you need to show off the watch kind of thing. It just makes you look weaker, I think. And that's something I would tell younger, especially dudes. Dudes kind of sucker into this more, I think. The status items, like they get kind of like a ego boost from it, or some type of value, perceived value, and at the end of the day, it really becomes a crutch, because eventually you're going to need it. If you don't have it, you're going to feel like you're less of a person. And I think that's just a toxic thing. So if you can avoid it, just stay away from the flashy things. You don't need it, like what you think you do. Just, and it's really the opposite of a snowball. It just takes away from what you can do, especially early on in your life. But anyway, that's the last slide. It's a hope this is helpful. I'm gonna watch this back a few times and probably laugh as I get older and look back at it and see what things. But I was trying to think of some slides to put together. I knew it was gonna be a longer video. Try to keep it under 40 minutes. But yeah. Anyway, have a great rest of your day and have a good 2025.